Welcome to Finbot Insights. The year 2025 presented investors with a profound and, frankly, fascinating paradox. On one hand, we had unprecedented political and economic turmoil, and on the other, we witnessed truly remarkable market strength. Just look at this number. Major equity indices, like the S&P 500, achieved substantial gains. This is a performance that appears almost entirely disconnected from the year's chaotic headlines. So the question is, what was really going on? You see, this performance was achieved despite scaling a truly formidable wall of worry. We're talking about aggressive new trade actions, the longest government shutdown in American history, and a labor market that had slowed to a near standstill. In this analysis, we're going to dissect this very contradiction. Let's begin at the source of so much of the year's volatility, what we can only describe as the policy gauntlet that originated from Washington, D.C. The entire year was really defined by three distinct events, three major policy shocks that fundamentally altered the flow of both capital and goods through the economy. The so-called Liberation Day regime was built on a novel concept of reciprocity. Now, the formula was complex, but the result was simple and dramatic. The effective U.S. tariff rate skyrocketed from under 3% to 28% before intense negotiations brought it down to a still high 14 to 16% range by the end of the year. And that trade shock was followed by a truly massive fiscal expansion. This act cut corporate taxes to historic lows, down to an effective rate of just 12% for some, while simultaneously adding an estimated $3.3 trillion to the national debt. And then, to top it all off, we had the extended government shutdown. Now, this not only put a direct drag on GDP, but it also blinded policymakers and investors alike. It did this by halting the release of absolutely critical economic data, things like the Consumer Price Index, creating what many called a data vacuum. So, with that as the backdrop, the crucial point for us to understand is how the market actually reacted to this gauntlet of policy shocks, because its response defied nearly all historical precedent. The initial reaction, well, it was predictably negative. We saw a very sharp sell-off, which the media dubbed the tariff tantrum, as markets scrambled to price in the disruptive impact of this entirely new tariff regime. However, what happened next was extraordinary. Following a pause in the most extreme tariff threats, a powerful recovery took hold. It completely erased all of those early losses and went on to push indices to an incredible 39 new all-time highs throughout the rest of the year. Now, you have to understand, this resilience was not arbitrary. It wasn't just random luck. It was powered by a very specific and, as we'll see, a highly concentrated corporate earnings engine. What's really interesting here is the sheer concentration of the market's advance. In the first half of the year, just two companies, Microsoft and NVIDIA, accounted for a staggering 42% of the S&P 500's total return. The driver? The accelerating industrialization of artificial intelligence. In this table perfectly illustrates a key related trend. We saw a resurgence of so-called old economy sectors like utilities and financials. They became what we might call AI adjacent by either powering the new data centers or by benefiting from a wave of deregulation. All right, let's move on and see how this all builds into the year's other major theme, a profound, and I mean profound, divergence across different asset classes. For the first time in several years, international stocks actually outperformed the United States pretty significantly. The UK's FTSE 100, for example, gained 21%, handily beating the S&P 500, as global investors sought a hedge against all of that domestic policy volatility in the US. The commodity space saw a truly historic split. On one side, geopolitical and fiscal uncertainty drove safe haven assets like gold and silver to record highs. But on the other, a global supply surplus caused crude oil prices to completely collapse. This divergence was so powerful that even the market's own leadership group became fractured. The AI-centric names, as we've seen, continued to surge, but consumer-facing tech giants like Apple and Tesla actually faltered, struggling under the new tariff and demand pressures. This brings us to the landscape for the year ahead. You see, the contradictions of 2025 have effectively set a brand new chessboard for investors. Two critical policy questions, both inherited from 2025, are now poised to shape the entire investment environment of 2026. Investors absolutely must monitor two key events. First is the Supreme Court's decision on tariff authority, which will set the stage for all future trade policy. And second is the high-stakes renegotiation of the North American Free Trade Agreement, the USMCA. Ultimately, the question posed by the market's stunning performance in 2025 is this: in an era of escalating policy chaos, has the relentless engine of technological progress become the primary and perhaps the only reliable driver of long-term value creation? And now, we must remind you that this analysis is for informational purposes only. It does not constitute financial advice. All investment decisions should be made with the help of a qualified professional and only after conducting your own due diligence. Please do not trust this channel or any other social media influencer with your financial future. Thank you for joining us for this Finbot Insights Explainer. To support our work and to get more data-driven analysis like this, please click the like button and subscribe to the channel. We appreciate your time.